All right. Well, thank you all for tuning in to our Navigating the Coronavirus Economy series. My name is Tom Dufour. I'm the CEO of Big Sky Franchise Team. And one of the things that we always are thinking about and looking about in trying to expand our business is as how things relate and pertain to uh, securing funding and financing. And so we've had PGV Advisors on our Navigating the Coronavirus Economy series in the past. And in speaking with Sam and Chris, who are going to be presenting today, over the last few weeks, they've brought to our attention some of the changes and things that are happening because of the current economic climate, things to be aware of for commercial lending, and things as a small business or any size business that you should be aware of. And so they're here today to share some fantastic news with us and fantastic information about what you should be paying attention to, things to pay attention to. So with that being said, I will turn things over to Chris and to Sam to share with us some additional information, and they'll fill you in a little bit on their background and on their company. So Sam and Chris, thank you both for being here.
Thank you, Tom. Appreciate it. Appreciate you inviting us on today. We look forward to sharing some useful information on real estate investing and financing with the group today. Just by background, my name is Chris Clabby, and I'm here along with my partner, Sam Datta. You might have heard from Sam in the past when we talked to some of your friends, Tom, about PPP and EIDL loans. Now that we're on the other side of coronavirus, hopefully, and starting to see things improve, you want to talk a little bit about what we're seeing in the marketplace, in particular with financing around real estate and the opportunity for business owners that may currently rent or thinking about investing, and just kind of roll in the financing part of that and how that plays into some of the opportunities that are in the marketplace. I will share my screen. Oops. Trying to advance the slides here, but there we go. So there's our pretty faces. A little bit about Sam and I. We're both experienced finance executives. Tom mentioned the name PGV Advisors. That's the company Sam and I started about 6 years ago to work with business owners and entrepreneurs to help them grow their companies and add value and become more profitable at what they do. And through that process, we learned quickly that the number one issue that most owners were running into were financing and how to get it cost-effective financing for a lot of their projects, or even get financing for their projects. So we launched Business Lending Partners. And just quickly about Business Lending Partners, Sam and I are both business owners. There's a lot of companies out there that help with financing, but most of them are bankers. They're not business owners. And we formed this company to provide a service to business owners by a business owner. So we understand what your struggles are daily in financing your business. And really what we try to do is put together a portfolio of pre-qualified lenders. So we've vetted through a lot of different lenders that we work with over the years, some good, some not so good. The not so good ones we eliminate. So when our clients come to us and ask us for help, we kind of know which direction to go to, depending on the scenario that they bring us in terms of what they want to do and who's the lender that fits their scenario. Kind of cut out a lot of the time that's wasted on trying to find the right lender. We've developed a proprietary process to help manage the flow of data. As anybody who's applied for a loan or a mortgage on their house, they know there's a lot of paper going back and forth, and we've tried to help streamline that. And lastly, we've added to our team experienced advisors, right? We're not brokers, we're advisors. And the people we bring on, we'd like to see that entrepreneurial spirit and the creative problem solving. If it was as simple as filling out an application and going to your bank, every deal would get funded. But it's really marketing, understanding the facts that you have, and marketing your particular transaction to a bank to make it appealing to them. And that's what we do. So today what we wanted to talk about, again, as we started off, was what's a unique opportunity for you in the marketplace as a business owner to invest in real estate, maybe refinance what you already have, what the options are available for you, or if you're renting, whether it's retail space, a manufacturing facility, is there an opportunity to buy that? And what we found is the number one issue in preventing a good real estate deal from going through is the inability to get financing or the right financing. And it often gets put on the back shelf, and people worry about it later. They're busy negotiating a purchase price or some other part of the deal, and the financing gets lost. And so we're hopefully can lay out some things that we're seeing in the marketplace for you today so that you can consider it as you move it forward. And again, so we're going along, we're here to answer any questions as we go along. Sam,
all right. Yes, thank you, Chris. Thank you, team. Good to be here. Think about why acquire or refinance real estate now. Look into the rates. This is one of the lowest rate we have seen in our lifetime. Federal fund rate are 25 basis points, so it's almost zero. Prime rate is 3.25. So I know if you think about your house mortgage and the rates that you get, commercial can get even better. So there are a lot of opportunities to refinance and restructuring your real estate. Now, also due to COVID, this is also, interestingly, a few months ago, I was invited to Federal Reserve for a town hall meeting, and we discussed about what's coming in the pipeline. And, there are a lot of people were there, like Bob Nardelli and few people like that, and they were in that meeting. And everybody thinks, and even Federal Reserve thinks, that next year is also going to be very difficult for commercial real estate. Means a lot of the properties are going to be vacant. So there's a unique opportunity to purchase. Eventually it's going to turn around. So there are a lot of companies, they're going for bankruptcies, who owns real estate because they can't make their ends meet, right? So they have to do something. Either they refinance, restructure, or sell. So a lot of investors are coming in now to buy those assets. Are you one of those investors? You need to think about that. This is a good opportunity this time to own real estate. If you own, let's say, a restaurants or any business, and if you lease this, is that a time for you to think and see if you can buy that property and hold it? You can get it at probably a better price now, and the interest rate is pretty low. And we'll talk about some of the interest rate and different techniques that you might be able to take advantage of in the marketplace. Next slide, Chris.
Yeah. And I think just before we move to the next slide, an important part there to realize is, you're talking about troubled borrowers or troubled owners. The real estate itself is very good. It's not a troubled asset. You can take advantage of just the timing that maybe someone else has overextended themselves. And when you look at a lot of these restaurants, they're in strip malls, so is there an opportunity not just to acquire the restaurant, but the entire strip mall and be the landlord? So really is a unique time.
Good point.
So the most obvious place that anyone goes when they're looking for a loan is their bank. A lot of us bank with either a large national bank, the names, or we're banking with a regional bank that's, in our area for, I'm in Florida. I know, Sam, you're in Atlanta. So, somewhere in the Southeast. And that's just a natural thought to go there. But you kind of have to think about how the banks work. And when you go and you talk to your representative, your account manager, those are salespeople. They want to bank you. They want to lend and provide every financial tool that they can to you, but they're not the ones making the decisions. There's an underwriting department. And banks have regulatory requirements that are pretty strict. So when you talk to your particular banker, they're always going to be enthused about helping you, whether it's acquire a piece of real estate or refinance it. But the reality is they may be constricted by their underwriting rules or department. And so we're finding that there's a lot of folks that are surprised by that. They're going to, Chase or Wells Fargo or any of the large banks. And then they're finding out down the road that, their deal doesn't fit the very small box that the bank has put out. And so, you have to ask yourself, what are your other options? It doesn't mean that you can't bank it. It just means there's different categories of lenders and different programs that are available that can help you do that. Now, if you want to stay with your bank or a traditional bank, there are government programs that help make it easier for that bank to lend to you because they are getting some support or some guarantees from the federal government. And Sam, I don't know if you want to talk a little bit about the experience you had recently with some of these programs.
Chris is mentioning about the government programs. There are three basic government programs you need to think about, and I'll give you a rule of thumb to look into where the interest rate falls in or amortization falls in. So your lowest interest rate and highest amortization is HUD. Today you can get, if your property applies or complies with HUD, is 2.25 percentage point at 35 years of amortization. So imagine your monthly payment is going to be very, very low. The next is the Fannie and Freddie Mae, Fannie Mae and Freddie Mac. They are probably going to fit in between 3.5 to 4 percentage point at a 25 years amortization. And the third one, which is most of the people go in, is the SBA. And the SBA is going to be prime plus 1 or 2. So prime is 3.25. So you probably will see between 4.5 to 5.25. And SBA can be different terms. It can be 10 years terms or 15 years or 20 years terms. So it depends on what you need and how does it fit it in. Not everything goes on every bucket. There are limitations to what HUD will do. There are limitations what Fannie and Freddie will do. And there are certain things what SBA can be done. So you really need to know, and most of the time when we find, you don't have all the information. So we are here because of that. We try to figure it out what's best for you. Not only that, we position you to make sure you get the best. And so that structure is very critical. There's a government programs with a lot more scrutinies. So, but, what I heard, almost 60 to 70% of the program people who goes into HUD and Freddie and Fannie, they gets rejected. And most of the time, what we find from the back end is their paperwork is not done properly, or they haven't structured their company properly. So it's not that you don't have the credit or you don't have the means to get the loan. Is most of the time is the right paperwork and the right structure, and does it fit it in? And you certainly need someone to help you. Will bank help you on those? Sometimes they do, but the banks generally are pushing so many paperwork and so many loans, and so you are just one of the numbers. So you rather find people that can help you as advisors, and then we can take you to the right direction.
And thanks, Sam. And I think the key there is like if you kind of look at a scale, that there's, for better rates and longer amortization periods, the trade-off is more restrictive program. And again, it's not something that can't be overcome, but you do have to be very, very careful when you're going through, as Sam pointed out, to make sure every box is checked and the information is presented the right way. And let's be realistic, it's like any business. A bank is a business. So when they're getting a pipeline of opportunities come in, they want to work on the deals that are the cleanest and the easiest to get through the underwriting process. So you want to make sure yours stands out and that they look at it quickly and they say, this is something we can bank. if you don't fall into a government program, there are other lenders. They're get harder and harder to find. Some of them are not necessarily showing up in a Google search, but life insurance companies do also lend. They're very similar to, the government programs. The rates are good, but very stringent requirements. And then you get to, and again, as we move down the list, the cost of money gets more expensive. There are alternative lenders, private real estate funds, and what they call hard money lenders. Usually hard money lenders are individuals, wealthy individuals that, have set up their own private fund to lend. What they tend to do is if let's call it a sloppier deal, it's still a good piece of real estate. It's still a good transaction, but it doesn't fit nice and neatly into a bank or a government program. What you find is these alternative lenders and real estate funds, they're willing to take a little bit more risk. The money may become a little more expensive. But the nice thing about those is they're also more flexible. So where a bank or a government program may have very stringent terms and they're not negotiable, these other lenders will look at things that the banks and the government programs won't necessarily look at. So if you have something unique in your transaction that you need to consider, these are good options. And all these lenders are lending, right? So they're looking at this as an opportunity as well for good deals that are out there, that they're happy to look at them.
Yeah, so the loan application is, the first thing and very important. So specifically, you need to look into, do you have good credit? And again, if you don't have good credit, how do you fix that? Critical. Bankruptcies, no bankruptcies, or when did you have a bankruptcy? Strong operating history. So looking into last few years of historical data. Have you been profitable? Have you been paying taxes? Those are very critical, because at the end of the day, you might have a lot of money in bank or cash there, but they are going to see your ongoing business and operating history. Are you really making money going forward? Do you have enough assets in the books? Are you leveraged enough? So there's so many things need to be looked into. As I said before, 60 to 70% of the loan applications for HUD and Freddie Fannie get disqualified because there are a lot of reasons for that. And that's where we come in and guide you to make sure your loan application is properly done. And then eventually, when you apply, there is a very, very high chance that you will get approved.
Yeah, and to that, when they look at it from a financial perspective, the first hurdle to clear, they think about, can you fund the debt service from your cash flow? And from that is not just the monthly payments, but what are you going to invest in the deal? The banks, no one's going to fund 100% of a transaction, but they will look at it and say, depending on the strength of the deal, a good strong deal, maybe you can get away with a 10% equity infusion. Deals are not as strong, may require a little bit more in the deal. And if your cash flow is inconsistent, they're going to look at that ability to fund the debt service going forward. So, the question on, do you need to put more into the deal up front to make the debt service manageable is what the bank is going to be looking at. And again, Sam hit on previous financial performance. And then lots of times you get a deal done on a believable forecast. And what do I mean by believable is we had a client recently that closed on a transaction. The financials were good. His historical, been in business for about 10 years and had good numbers, not great, nothing that would blow you away, but they had some really good strategic initiatives and process that were going to change things going forward. And again, it was kind of buried in an Excel spreadsheet, and what we're able to do was able to pull out and tell the story to the lender as to why their future profitability was going to be much better than what they had achieved in the past. And by storytelling and pulling their financial presentation out and presenting it a little bit differently, so it was easy for the lender to see, we're able to get their deal funded. And that one went through an SBA. That their own bank, which was an SBA lender, was really unable to do. So you can close a deal on a forecast, but the facts have to be there, either previous history of doing it somewhere else, or your ability to support the story with real live factual data.
And Chris and Sam, just a
Yeah.
question that came up here. One of the attendees asked, is Business Lending Partners a lender?
So we are not. We're not a third-party lender. We sit between the borrower and the actual lenders. What we have done is put together a portfolio of lenders in different categories, whether it's real estate, whether it's operating capital, whether it's term loans. We've kind of vetted through that and have identified the lenders that we find our clients enjoy working with and have the best programs for the type of transaction that you're looking to do. So we advise clients and help connect them with the right sources of capital.
And the other thing is, this slide also talks about that, Tom, to answer that question. There are thousands of lenders. Who is right for you? Who is going to approve you? You can go one at a time, and then you'll be exhausted. And this is where we play a significant role. And we have put together a very, very qualified mix of lenders that know what's their main portfolio. What do they like? What are the things that they will provide the loan or not? And so we really channel that. It's just a big funnel. You got to channel it to the right way, because we can bring this to 2 or 3 lenders, and we're very confident when we bring it that you are going to get that funded. I'll give you an example to this. This is a right segue. We during this COVID time, we did some PPP work, and they came in, and they a great team that they buy properties, renovate, and rent. So it's a multi-family. So a year and a half ago, they took a $1.1 million loan to buy the property. When they bought it, they're paying like an 11% interest rate. It's pretty much like a bridge loan. So because this is the time they're renovating. And then time got delayed. We came in earlier in this year when all the COVID started, and we looked into that. I said, why are you paying that high interest? Well, that's the best we found. I said, all right, let us help you. And that fit into very good with the HUD program. So the phase 1, what we did, and the cost was around $2.2 million. They bought it for 1.1. They put another $1.1 million of their own money to renovate. So we first refinanced their existing cost structure and got almost 90% of the cost on $1.9 million loan at a 4.5% interest as a bridge loan. So we started with the bridge loan, so that way they got their money out because they are paying 11% interest. They put a lot of their own money. They got majority of the back. And then we converted that to a HUD loan. HUD takes 6 months or so. And on the HUD, the valuation of the company, because it's all rented out, it became $5.5 million. And so we closed it at $4.2 million in a HUD loan at a 2.7% interest rate at 35 years of amortization. And just stop and think, and you'll see the benefit. So they pretty much got $2 million cash out, and the whole loan is 2.7% at a 35 years. And their cash flow is paying for that. The 60 units, they're getting $60,000 so revenue. And so it is a win-win situation from all aspects. So, but guess what? If we worked with them before, when they bought the company, we could have got them at a 4.5%, 5% interest for a bridge loan. But they were paying almost a year and a half at 11%, and then from their pocket. Who is going to guide those things? That's the key to this success.
Yeah, and the key that they still haven't even measured on that one is their ability to pull their cash out and move it to the next deal.
Yeah.
Which, it's even greater returns than that, and the money's so inexpensive. But that's a great example, Sam.
Yeah. Anything else on this, Chris?
No, I think just that, when we talk about underwriting, I mentioned before that any deal coming in is going to go to underwriting. The key here is know where your weaknesses are. Know everybody's got a dead body in the closet somewhere. Know what it is. Address it early. Don't try to hide it. It will come out, and you'll be further down the road and have invested a lot of time in a transaction. And it could be a deal killer, or it could be something that if you address it up front, you can overcome it. So just whether you work directly with your bank or you work with someone like us, kind of knowing what those weaknesses are and what those problems could be, it's really good to have a discussion up front, so you can kind of either say, yeah, you won't be able to bank this deal, or here's the considerations that you may need to take in. And one of them is, Sam mentioned before, the bankruptcy. A bankruptcy a few years ago that has been resolved and is something that we would probably work with. A bankruptcy that went in 6 months ago is probably a little more difficult, but you don't want to be down the road and telling your bank or your lender about it. Mm-hmm. On this one, just talk a little bit, what has changed. You're kind of coming post-COVID. Like I said, lenders are reviewing deals, but they're getting more cautious. If it was a good deal before COVID struck, it's still a good deal now. What's changing? So loan to value, where banks were confident before, they've lowered the LTV, the amount they'll advance on an appraised value. And so if they were doing 80% before, maybe they're doing 70% now. And a lot of that will depend on where your real estate's located. Something that's in a major market that and again, lenders look at loan to value as, if you default, they're left with a piece of real estate. How quickly could they either sell it or get somebody else in there? So location and condition of the property gets in, but that's something that. Go ahead.
And also, Chris, I think especially due to COVID, the lenders are also looking into the type of properties or in the industry. Correct. And they've adjusted. Give you an example, we just finished working with a hotel. Those are very hard to structure now or get loan, but we used to get 85% from even Freddie, Fannie, or any other SBA loan. Now they're at 65%. And majority of the banks or lending companies as well, we want to wait. We don't want to do hotels. On the other hand, when you look at multifamily, which are in a high demand, those are still, we can get it at 90%. So again, depends on the type of properties and what you're trying to do, what, in the industry you are in. We can guide you and to set expectations properly. But again, it could be temporarily, but you still need the cash, or you still need to reduce your exposure this time. This is very critical.
Good point. To that point, the other thing we talked about before is the debt service. So banks have what they call a debt service coverage ratio. So they're looking at your income or your cash flow, and they peg a number to it. So where they would do maybe 1.25, whatever your cash flow is on a monthly basis, they're increasing that to a 1.5 or a 1.6. They want a little more cushion. What they're trying to do is protect themselves. And so they're making it a little harder to get approved. But again, if you've got a good deal, that's shouldn't be an issue, and you can still get it through the process. The last point is just the appraised value versus a net income approach. Sam was mentioning multifamily housing, anything that's tenant occupied. Sometimes people approach us and they have an appraisal on the brick and mortar of their building. Banks underwriting that. If you've got a tenant, they're looking at really net income that's coming off that property, and that's how they're going to appraise or look at the appraisal of the building. So we've got one right now where it's a healthcare company and their buildings are in rural locations. Well, every lender is kind of looking at that and saying, that building is in the middle of a small town. It's a special use building. I couldn't get another tenant in. I'm stuck with a building with not really much value. So they're really appraising the building on the ability to rent it out, and what would that net income be. So keep that in mind as you talk to folks in terms of how a building's being valued.
Yep.
Sam, I don't know if you want to talk a little bit about loan terms.
Chris, yeah, Chris and Sam, there was a question that came across here that just asked if you work with any specific industries as you're going through this.
No, I would say we are pretty agnostic. But majority of the industries that we get, manufacturing, retail, hospitality, service, IT services, real estate. But generally, as long as this is a fixed asset, buildings, we can certainly do that. So yeah, so good question. So the loan terms, you know, it's most of the time people think about, okay, what's my rate? Rate is one thing, and as we just talked about, rates are pretty low. So you got to look into all the other stuff, what's there, right? So personal guarantee versus collateral. A lot of the lending companies, and depends on your history, they're going to look into that. Okay, what collateral do you have? Yes, the building is collateral, great, but still they want some personal guarantee. So looking into your personal financial statement, how much personal guarantee do you want to give or not? It's a sensitive issue, but we got to be realistic what's needed or not. It all depends on your financial situation, your business situations, and we'll guide you that way. Amortization period versus balloon payments. You know, we have seen many deals that so great, we got a fantastic rate, but it's in 5 years from now, interest only, and 5 years from now, you got to pay the whole thing. Yeah, you might have saved a few dollars per month, but what happens after 5 years? Are you willing to take that risk? And then looking into the amortization period is part of that. Many times, you know, the lending company will give you as, okay, the amortization period of this building or this property is 15 years, versus if we can get you 20, 25, 30, 35 years, your interest, your total payment is going to be very low. So you got to balance it out. And depends on what situation are you in, right? So you might want it to, you know, go for a smaller, in a term, because you know you wanted to sell this in a few years. So there's many structures out there. So we generally try to put what makes sense for you and give you options so you can look into. And that's the way we can negotiate based on the lenders, because every lender have their different way of giving you, you know, the term sheet. And that's why we're there. There are a lot of fine lines in the term sheet when we look into that. How do you read through that? There are so many fees, hidden fees that we talk about. There are, you know, 1% there, or there's some attorney's fee, this fee. It all adds up at the end of the day. So you got to look into all of those before it makes sense and what's the best for you. Also, many times what happens, there are certain lenders, they want some reports on a monthly basis. If it is a factoring that we are doing, yeah, it's not real estate, but they want something on a weekly basis. Sometimes you got to look into, is that adding a lot of additional work for your side? And is it going to be a lot of risk? And so you need to look into, you know, peel that onion on the term sheet and figure it out, what is actually costing you, what's actually your effective rate, and then make those decisions. Sometimes it's blaring as, well, we got you a 2.2% interest for this, but then you will find, yeah, you got to pay another 100 basis points for insurance every year. So that's mean it's 3.2 already. Then you have a lot of fees, so your effective interest goes up to 4.5. But on the paper, first thing you see, well, great, 2.2% interest, but it's not the fact. So you know, it is very difficult to read all those through without having knowledge and working on a daily basis that, okay, this is the way they get you. That's why you also need an outside advisor to guide you. So, you know, one of the questions that comes in, Chris, might be, so all those things that people come in will ask us, okay, so how do you guys charge for your services? So Chris, you might want to answer that.
Sure. That's fair. So we don't have, in general, we're getting paid for successful deals that close, and we get paid a percentage of whatever the amount financed is. So there's no risk to to you, if we can't get a deal closed, you really owe us nothing. There's we apply a sliding scale to that. I mean, obviously a simpler deal that we can get through gets a lower rate, and more complex deal where we have to be more involved to help package and market and dig through the information to help the business owner put it together, that may be on the higher end. But again, for us, we look at every transaction up front. We don't want to take something on that you can go to your bank for. So if we feel like you can get this done just by going to your current bank, we'll tell you that right up. We want to add value to a situation for you. And lots of times we find that people come to us after they've tried to do it on their own and had a little frustration, or have been rejected and are surprised that they were rejected. So we're here to help, on that end. But again, if you haven't brought your deal to your bank, we're happy to look at it. And if we think it's straight up, we'll let you know that you should probably try them first.
Next slide.
Yeah, and so I think that leads into, Sam, what you're asking, when to use an advisor. Obviously, if you're not a fit for your bank profile, either, you can find out on your own and talk to your bank and figure it out, or, we're happy to look at those transactions. Again, complex transactions, what do we mean by that? Again, if there's been, if the financials don't look great, or if there's been a bankruptcy, or it's not as straightforward as Sam described before, something that fit a government program, but it wasn't straight in and needed, bridge financing. Those are the more complex ones. We're very good at structuring that and putting those lenders together. If you want competitive term sheets, again, Sam pointed out before, do you want to go to multiple banks and provide information multiple times, where people are looking and they're not sure we're going to get the best rates? They know if they provide the information through someone like us, we can get it out to multiple lenders, and get back competitive term sheets, and then kind of vet them against each other. And again, pricing, we find that we're able to get some things done just based upon our relationship with the lenders that people probably can't get done on their own, because we work with these lenders over and over again. So whether it's, rate, or the terms and conditions on a loan, those are the things that we've got a little more leverage because of our existing relationship, past deals we've done with the lenders, or even, them acknowledging that there's future work that we're going to send their way as well. Sam, I don't know if you want to add to that.
No, I think you're fine.
So that kind of brings it to the end of what we wanted to talk about. I was happy to, I know we've kind of run over time here, but happy to take any additional questions, Tom, if there are any other questions coming in.
Oh, that's great, guys. Well, thank you. Yeah, I don't have any other questions, but we'll open it up for questions. There's nothing on the board here, so I'll go ahead and open up for questions for anyone who's on with us for the day. I mean, I guess I would ask a question, Sam and Chris, is if someone's interested in exploring what this might look like, just, what's the best way for someone to get a hold of you or reach out to you?
Yes, so we got our email address and phone number. Either way, you can go through the website. You can send a question. Our contact informations are there in this presentation as well. So you can email at datta@pgvadvisors.com, or chris.clabby@pgvadvisors.com, or go to our website and send questions, and we'll respond very quickly.
Okay,
yeah.
Great. And
Tom, we're happy to walk through a transaction with anybody and share our insight. If we can help them, happy to help them. If it's something that they can get done on their own and we've just shared some advice, then, that's fine as well.
Great. Well, thank you for being here. Are there any other questions from the audience or from our attendees? I'm not seeing any in here. Please feel free to type them in or unmute yourself and ask. Otherwise, Chris and Sam, thank you so much for being here. We appreciate it. And if you came in a little bit later to this, we will rebroadcast this and have this published for future viewing. So we greatly appreciate you helping us and providing us with some great information and being a valuable resource.
Thank you.
Thank you, Tom.
All right. Thank you all. Have a great weekend. Have a great rest of the day.